And it's also very clear that the market is able to rebound from literally the most historic like exchange related disruptions, and it rebounded really rather quickly. So I mean, I find this extremely shocking that, knock on wood, we're on pace to hit all-time high again in option block volume.
Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting, so the obvious trade is always the expensive one to
this
carry.
Whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hey everyone, welcome to The Big Picture. My name is Joe Cruey. I'm at Paradigm, in the weeds around everything crypto vol. I'm joined here by Sohan on our sales team in Asia, who joined us last week when we spoke to Caroline at Orbit, as well as David, who's back from his brief hiatus after being you're in Barcelona, right, David?
Barcelona, yeah, the European Blockchain Conference. How
was that?
Yeah, it was good, man. It was, there was a good vibe there. It was a good buzz. If I compare it to some of the events I went to back in December, it certainly felt like crypto was back in quite a big way. It was cool. There's like a really good breadth of sort of attendees there. It was kind of a good reminder that there's a lot of money flowing into this space still. Apparently as well, there was double the attendees from the previous year. So, man, bull market might be back after all. But it was good. It was good connecting with a lot of people there. Quite a few allocators there. So there's still money coming into this place, and like the appetite for blockchain seemed huge. It was cool.
Well, look, I mean, if you're a VC or an investor in this space, and you're looking to get in when the valuations are not crazy 2021 sort of levels. I mean, this is kind of the time if you're an investor looking to get some exposure to the space. So I'm sure there's a lot of guys there as well. I mean, as you said, there's still a lot of really interesting things going on in the space. And I mean, luckily, the coins have really rallied to start the year. So some of that fervor, it kind of feels, at least in the options market, that fervor is starting to really come back.
Yeah, no, it's great. And I kind of feel like it's reinforced the idea that I had post FTX, that kind of anyone that was moving into the space kind of knew the risks, and they've been building for a while and starting to put in place the infrastructure to come into it. It was kind of reassuring just to sort of meet with like some traditional sort of funds and stuff as well that were there, who were building, and like some like TradFi asset managers who are still sort of big in TradFi, but building out crypto desks and things like that. It's quite interesting to speak to them and not put off by what's gone on. But again, the focus was very much, how are we dealing with counterparty credit risk? What are solutions to that? What are the custody solutions to that? Any other kind of prime broker solutions and credit intermediation? So it's very much kind of solution focused, not crypto's dead. It was a big Ponzi. We knew it, and let's forget about it. It was quite a good vibe. You can probably tell I'm full of cold and like burnt the candle at both ends as well. So maybe a little bit too much sangria and enjoying the party scene out there.
That was real fun. With that in February, right?
I know. Weather was nice as well, so that was cool.
All right, good. Well, we'll be back with guests next week, but I thought we'd use this time to go over some of the more interesting crypto option block data that we've been looking at. Here at Paradigm, we've really been starting to focus on like building out this sort of proprietary sort of data offering. What is data that at Paradigm we can present to the market that you cannot find anywhere else? So like what we'll do today is we'll start a little bit more general, and then we'll get more granular, right? Specifically, we'll talk about the growth of the crypto option block volume into 2023, potentially what is explaining that growth, what times of the days and days of the weeks is block markets most busy? What is the breakdown of multi-leg trades versus single leg volume? So like consider what we're going to talk about today kind of as like a teaser to a quarterly report that is going to start coming being published by Paradigm that is includes some of the data that we're going to talk about today. But in that report, we're also going to be including stats around like liquidity, block liquidity or Greeks exposure by maturities and strikes. And as the viewers and our audience, we would love to hear in the comments, either on Twitter or YouTube, wherever you're watching this, in terms of what are things that you would like to see that would be very valuable. So we'll jump right into it. Let me share my screen. Well, okay, so this chart right here. So block trading of crypto options in 2022, as you can tell from the chart, it continued to really thrive, despite the spot market turmoil. And for those that are, potentially new to the podcast, what is an option block trade, right? An option block trade, it refers to a significant transaction of options contracts that are traded outside of public order books on a privately negotiated basis, but still settles on the exchange, i.e. Deribit. So a block trade on Deribit must meet the minimum size requirement of 25 contracts of Bitcoin or 250 contracts of Ethereum in a single strategy. And then, of course, use the pre-existing contracts that exist from the exchange. So from the chart, you can tell, so Paradigm option block volumes experienced tremendous growth in 2022, right? So if we look at that chart, so January 2022, we were at 150,000 Bitcoin notional, right? And then fast forward about a year later, and we're basically triple that size, right? And so that last chart right there, so for February volumes, I mean, we're not fully through February yet, we're about 3/4 through at the time of recording, and we forecasted it through the rest of the month. And February is looking like it's going to be another all-time high, right? And overlaid on this chart as well is the 1 month realized vol that, as you can tell, I mean, February, I mean, it's been decent, but it's still been quite low, right? And the month-to-date spot returns are pretty marginal as well, right? So it's super promising, right? So volumes are increasing in option block contracts, even when the market isn't too volatile. The spot peak to trough, I think, in Bitcoin over the month of February is only like 14%, right? Compared to January, we had this massive 40% rally. You could have made this argument, like, look, yeah, we had this massive rally, people putting money to work at the beginning of the year. Of course, you're going to get outsized volumes. But when you look at the chart, right, January doesn't really look as much of an anomaly anymore, right? We have realized vol in February that's fairly low, right? The market's not nearly as exciting as it was, right? The peak to trough spot range is not that high. So, and the volumes are continuing to increase, which kind of tells us, I mean, of course, we're biased, that this market is here to stay. And it's also very clear that the market is able to rebound from literally the most historic, like, exchange-related disruptions, and it rebounded really rather quickly. So I mean, I find this extremely shocking that, knock on wood, we're on pace to hit all-time high again in option block volumes. What do you guys think?
Yeah, I mean, I think one of the ways you need to think about blocks is it's the more institutional size, right? I mean, it's the non-retail players. So if realized vol is low, there's no dramatic need for people to go in and hedge their risk and buy options or sell options. So what this tells me is there's real demand for people to come in and express a view via options, and it's a directional view, right? So, and it's institutional players that are coming in to do that, which is obviously very promising for us. Right.
Yeah, I mean, I think that being said, when I first pulled this chart, I would have thought, okay, the highest volume months are going to be the ones on average that have the most, have the highest sort of realized vol when the market's moving around a lot. And you actually look at the correlation of the trailing 1 month realized vol versus our volumes, and there's really no correlation at all, which is a good thing, because that's saying that the volumes are not dependent so much of what's happening in the spot market. It's rather the market is just continuing to grow because more institutional players are actually entering, and more people are realizing that crypto options are actually a thing, and you can actually get access to these things, and the markets are tight.
Yeah, I mean, so what you're basically saying is that as a percentage of the spot market, I guess we are continuing to grow, right?
Right.
Which yeah, that's great news.
Right. I mean, that being
Yes.
said, I mean, let's not get over our skis here, right? I mean, like a big day on Deribit 24-hour option volumes between like Bitcoin and Ethereum is like $1.5 billion, right? Like that's, if you compare that to, just I come from the equity options background, right? We would be like at JP Morgan, we'd be doing 3 times that size in a single trade of S&P options, right? It's like the daily option volumes of Bitcoin and Ethereum combined are kind of like a mid-tier sort of, NASDAQ stock. But, that being said, it is continuing to grow. And, hopefully we start to see, as FTX kind of moves more into the background, and we start to figure out some of these custody solutions over time that David was mentioning, that we actually start to see a bit more, exponential growth rather than, kind of, I mean, you kind of look in the chart, right? It kind of looks like a logarithmic sort of growth, right? Instead of like an exponential sort of growth. But, that being said, it still is a success in itself that that the volumes have continued to grow, despite the fact, FTX was only 2 months ago.
Yeah, I think there's a couple of things that are interesting for me. Actually, when I look at that chart, if you took out December, like you could pretty much draw a steady like uptrend in terms of the growth. And I kind of think, that speaks to how, say, the institutions are still coming into the space, which we're obviously very exposed to here. And also as the pie itself kind of grows. I mean, to your point, not only is crypto as an asset class still very, very small compared to the traditional world, but then within that asset class, options is still very, very small as well. So I think options is something like 2% of the open interest of crypto derivatives, whereas in the TradFi world, that's like 20%. So when you kind of think of us as a business, and the growth opportunity here, you've got the growth opportunity in terms of crypto is going to get more, established and will grow as an asset class in itself. And then the role that options plays within that is going to become much bigger as it's used for speculation, used for hedging. They're going to play a vital role in that. And I think we're kind of seeing that this year already, right? In what's coming through. So I think it's an exciting time. And actually going back to Barcelona, I think a lot of the conversations we had around that, I mean, everything in crypto is on like hyper mode, right? We kind of reliving like the evolution of TradFi that went on over decades. We're kind of doing it on like hyper speed, including making all the same fuck ups and mistakes and what have you that crypto made, right? That TradFi made. And so I kind of don't think it's any different, and like it's still so early. And it's the thing, and when you're in the space, I think it probably ages you quite a bit, and it's like dog years in terms of working in crypto, but it is still so early. And yeah, there's some big TradFi guys that are just kind of sniffing around the space. I mean, the regulators still don't know what they're doing around it. So yeah, I kind of, it always takes me back to I think it was the Bill Gates quote that most people what's the saying? But most people achieve less than they think they're going to in a year, but tend to underachieve on a 10-year time frame. And I think that's crypto. Like even those are the most optimistic in the space, we kind of all get a little bit carried away in terms of where we think things will be in a year, but I think we probably underestimate where we'll be in 10. So it's kind of like everything needs a little bit of patience, but it's kind of stepping back and remembering we're super early in this game, and there's so much growth to come, so much money to come into the space, and you're starting to see that reflect in some of the charts and some of the flows. Certainly, I think that we're seeing.
Yeah, absolutely. And I mean, I would say block option volumes tends to be like a fairly decent proxy in terms of institutional participation, because as we mentioned, right, in order to be able to do a block trade, you need to have sufficient capital to do so, right? You need to be able to meet the contract sizes of 25 Bitcoin or 250 Ethereum. And right, so if I just go to this next chart here, and Yeah, ignore the title here. That shouldn't say multi-leg versus single leg option block flows. This is rather just the market share over time of blocks of option block volumes relative to the total option volumes that are trading on Deribit, right? So if we look back in 2019 of August for BTC, that number, so that would be that orange line, block percentage of total notional. Only 20% of the trades that were going through were block trades, right? Fast forward January 2023, now 40%, or February 2023, 40% of all the trades that are going through now are blocks. And Ethereum, it's showing a very similar picture of this long-term growth, where in Q3 2019, we were at 15%. And then by Q4 2022, we are at 30%, right? So even like we all agree that more institutions, as the custody issues and regulation hopefully gets sorted out, that more institutions are going to enter. But that being said, the institutions already have been entering. I mean, as I said, this is kind of a proxy for the amount of institutional involvement in this space. And it's kind of double, its proportion of the pie has doubled in a couple of years, right? So my opinion is okay, so you have this growing institutional participation that we talked about, but at the same time, we've also have a lot more improved liquidity. And in our quarterly report, I would love to be able to report on some of these stats, right? We've had this entry of more and more market makers that are enhancing the capacity for institutional takers to come in and trade these big block sizes at tighter bid offer spreads, right? And then also, I would also say that Deribit has done us a solid as well. Because I mean, even when I got here, the fees that you were paying in order to do a block trade were insane, right? If you're telling me that if I want to do a call fly structure that is effectively 4 legs, right, 1 by 2 by 1, you're telling me that I need to pay 3 basis points of fees on every one of those legs. Well, I mean, my point is so many of these trades were just so non-economic due to the fee structure. And now you have lower fees. So Deribit reduced the fees for multi-leg option strategies that combines legs that are trading in the opposite direction. So if I'm trading a call spread, for example, I would get fee netting between the long and the short leg. But if I were to trade a straddle or a strangle, I would not get that discount. But that being said, it's come a lot of ways, right? You have the growing institutional participation, better liquidity, spots moving around, lower fees. Yeah, there's a lot of things that are leading to this, but it's been a great story so far.
Yeah, it's awesome.
Yeah, I mean, I think one important point to note here is that the blue line is the block percentage of the total premium, right? So it's very easy to say blocks as a percentage of total notional but that notional is maybe irrelevant, right? I mean, it might be a super 1 delta option or like a 50 delta option, which is real, right? And you can see this is 60% of BTC blocks, by total premium. So that means it's real options that people are buying. It's not just wings, lottery tickets that are people buying. Again, pointing to the fact that it's real players who are coming in and trading this. So institutional.
Yeah, right.
Yeah,
and just to explain what Sohan's saying. So when you calculate notional of an option trade, effectively you're just taking the number of contracts times the current Bitcoin or Ethereum reference price. It doesn't account for the moneyness of the option or the amount of premium that's being paid. If I trade, when you just look at total notional, a Ethereum 5,000 strike call is going to have the same notional as a Ethereum 1,700 call. So that's why we included this blue line as well. Be okay, look, this isn't just a bunch of wingy option volumes are going through. This is actually real risk that is going through. All righty,
yeah, that's huge.
Let's move on. Yeah, well, I mean, I guess I can briefly mention this. I mean, if you look at this, is kind of just another proxy for institutional involvement. versus retail, I would say it's fair to say that retail is going to be much more likely to trade single-legged options, rather than multi-leg, right? Retail is just generally scared going short options, right? Even if you're just like trading a call spread, right? People are like, oh, like, people just get a bit nervous, right? As opposed to institutions that, are doing multi-leg strategies all the time, right? And you can basically look, so the green in this left chart has just continued to shrink while the blue has continued to increase. So that blue is the multi-leg proportion, and then that green is that single leg proportion. So you can kind of really tell that towards like the end of Q4 2021, this is what kind of really when the institutions really started to enter. And you can see that in the right chart as well. This is basically just the multi-leg option blocks as a percentage of notional, which was 30% in December 2021, and it just completely skyrocketed. Now we're at this steady state or so, where about 2/3 to 3/4 of the volume that is traded is coming in the form of multi-leg block options.
Yeah, and the fee reduction obviously has a lot to do with this as well,
Yes.
right? Because like the moment the exchange changes it to make it easier to do multi-legs, as in don't get charged on the second leg, almost everyone is like, well, now it makes sense to do a call spread, right? Before it was like, well, I don't want to pay twice the fee, so I'll just do one, and worst comes to worst, I'll do the next leg.
Right. I mean, I think the next big step for this market is the tied up delta hedge trading, right? I mean, like, so you came from FX, right? Like trading delta hedge, I would imagine, was pretty commonplace, right?
Yeah, I mean, so the market standard in almost all markets is, if you're a vol trader, you make a vol price. So you have a delta hedge, you don't care about the delta, and then that's it. But for some reason, and crypto has started off as a with with delta risk, and it will change. It will change over time because like I noticed many times, two of our dealers are dealing together, and both of them are clearing their delta at the same time, right? In the open market, they trade live, face each other, and then they clear the delta themselves. Which as you said, it's just a sign of a market which is gradually getting more mature. Like Paradigm didn't have the ability to do delta hedged like options until about a year ago. So it's just gradually the market will get better at this, I feel.
Yeah, I mean, a lot of it too, though, is like, so when you trade on Deribit, you can't cross versus spot, right? You need a cross versus the perp or the future. And I mean, nothing against Deribit, we love them, but like the liquidity of the perp in the future on Deribit versus the liquidity of the perp or the future on Binance is just completely night and day, right? If I get delivered this delta in the form of a Deribit perp or future, well, I need to be able to manage this thing. And the reality is there's a lot of cases where if I were to trade like OCO, an option structure live, not versus delta, in that same option structure versus delta, I would get a tighter price on the live versus the the delta exchange, right? That coming from equities, like that is just complete craziness to me, right? That this is a thing, and who knows? Maybe as more liquidity comes onto Deribit and the perps, or we kind of figure out this whole cross margin thing, right? Like, imagine if you could trade a Deribit option versus a Binance perp, right? Yeah, if you can do that, you deliver them delta that you can actually trade, or deliver or like a Binance Bitcoin spot, then I think the market gets a lot tighter.
Yeah, I mean, it's actually one of the main reasons why I feel there is that there is room for another exchange player to come in as an options exchange, right? Like, so like we have for example Bybit, right? They are able to they have a more liquid futures futures market.
Absolutely.
Right. So if you had something where, even if you don't have to do, like right now, people are doing cross exchange. I completely agree with that. Right. Like somebody trades on Deribit, then they look at Deribit future, it's too expensive, I'll hedge somewhere else. Right. And then his counterpart is also doing the same thing. Right. If there's one exchange where you can do everything, that would materially, save the liquidity, of the market. Actually, I think that might be the thing that we are yet to see, right? Which is you start merging the delta market, a liquid delta market, with the options market. That could really cause this to really roof.
Right.
What you need is like a liquidity network that's settlement agnostic, that you could do all of that in one place and then just settle where you want to settle.
Oh my God, Jesus.
I see.
Oh, here we are, Paradigm.
If you're an institutional investor who's like, or fund manager that's running a vol strategy in equity or FX, right? Who's used to doing everything delta hedge. And then you kind of realize that you're coming into here and you're introducing a lot of the slippage risk and the cross margin implications of managing your delta and your option risk on different exchanges. Well, that's kind of something that would cause that fund manager to be like, maybe this market isn't ready yet. Maybe we'll revisit when I can actually somewhat efficiently trade my vol strategy, right? For me, that's kind of like the next step of where this goes. But like, I mean, as at Paradigm, we're kind of the ones responsible for figuring out this problem. So we'll get there.
We will get there.
Yeah. And then I'll just finish on this. So this is a cool chart, right? So this is when our block option volumes are the highest. Right. So the below chart shows crypto block volumes by the hour of the day and the day of the week. Right. So the hours of the day are divided into these 8 blocks in UTC time, 0 to 3 UTC, 3 to 6, 6 to 9, so on and so forth. And then each colored bar represents a different day of the week. Right. So Monday is yellow, Friday is orange. And there's some pretty cool things to like interpret from this. And this is something that we're going to include in our report, in our quarterly report. Like, imagine if you're a market maker and you're like, I want to market make on Paradigm. And because of the nature of crypto, I need to have a global business, and maybe I'm located, in Asia or in Europe. When are the times of days that I need to be focusing the most in order to actually get the most volume? And this data is actually pretty enlightening, right? So the option block volume, it tends to follow this general trend of increasing throughout the UTC day, but it peaks around 12 to 15 UTC. I believe that's 8 a.m. New York time to 11 a.m. New York time. Right, so that's when the volumes of crypto option blocks are peaking, and then and then you get some activity as well in the afternoon of the US, but then it gradually decreases into the end of the US day. And then the highest activity buckets are actually Tuesdays and Wednesdays during this 12 to 15 UTC bucket. And I found it pretty interesting. If you were to ask me before pulling this data, when are the option volumes, what day of the week are option volumes the largest? I would have been like, I would imagine it's probably, Thursday into Friday, because that's when the option expiries are. And I mean, we're kind of splitting hairs here, right? Because Wednesday, Thursday, Friday volumes are kind of all similar, but I found it surprising that Wednesdays are actually the busiest days in terms of option volumes. Is Wednesday a big data day, David?
I guess it's when the Fed always is, and Fed minutes.
Oh, you're right.
But then again, that's not consistent, right? Throughout throughout a month, that's just one day, right? That's interesting as well. I think time wise, at 7 till 9, so like 12 to 15 is 7 till 9 New York time. So that in my head kind of makes sense, because I know crypto's 24/7, but if you think from the TradFi world, most traders sort of start their day at 7 o'clock. US arriving at 7 till 9, putting on positions, putting on risk. That kind of makes sense to me.
Yeah, so if you look at FX, it kind of looks exactly the same, because FX is also a global market, right? So basically, when New York walks in, is the most liquid time, because New York is there, London's there, and the stragglers in Asia are also there, right?
Yeah.
So you kind of get everyone together. What to me is most interesting here is that like many people in Asia are contributing to this volume, and they're not trading in Asia morning, right? Like if you look here, I mean, Asia morning is basically 0 to 9, right? I mean, that's the Asia morning afternoon. That time is, like those guys are waking up and not doing anything, and then they're trading when the market is more liquid, which is when US is here, when London's in. So yeah, it's very similar to FX, I feel, in behavior.
I'd love to know as well how, I mean, I can kind of infer, I imagine, but like how that impacts spreads as well. Like, so obviously those peak liquidity moments, the spread's much tighter, a lot more liquidity, which again might make you think in terms of, if you're running some kind of arb strategy, is actually you want to be operating in the wings of that chart.
Yeah, I mean,
for this report, right? We should overlay this data with the bid offer spread, and like the distance in which trades that are going up on Paradigm are clearing from their mark fair value over that time, to see if it actually is the case that, I mean, more volume, you would expect more liquidity, but let's back it up with the data. I think that'd be pretty interesting.
Yeah, it'd be cool.
All right,
and no real surprise in the weekend being dead, right? I mean, that's a pretty standard standard graph, but I'm still surprised by the fact that Monday is, I mean, it's not that different from Saturday, right?
No.
It's like, I mean, it's two times or whatever, but so it's still there. There are still prices being made. It's just it's obviously less.
Yeah, and if you're a market maker watching this and you don't want to be on the weekends, the highest volumes on the weekends are observed on, I think it looks like Saturdays from 12 to 15 UTC. So if you're looking to be active for 3 hours over the course of your weekends and log on to start trading, I mean, albeit like it's still very small, but that's probably where you want to focus your time if you're trying to take a break from your weekend boozing.
I'm surprised. I thought Monday would be higher, actually. Just because, again, like thinking back to from my FX days, like Monday, people come in, either something's gone on the weekend, so you're kind of reacting to that, or you're adjusting positions or putting on positions, that things that you like for the week. I would have thought Monday might have been a bit higher volumes. That's quite.
Yeah, I mean, I think that I had the exact same reaction, and I think it's tied into the fact that the weekend is kind of not zero, right? So basically, when we come in on Monday, we start dealing with all the other guys come back, even though it's 24/7. It's not really 24/7. Like, there's no liquidity on the weekend. So you come in, you start dealing on Monday, but here it's kind of getting split across. That Monday flow is getting split across Saturday, Sunday, and Monday, right?
Right, and don't get me wrong. There are days. I remember there was one day, I think June of last year. Remember we had like that big rally before the merge in the summer, where I logged on Saturday and like Ethereum was up 17%. I was like, oh my God. And that day felt like, a Wednesday during that 12 to 15 UTC bucket, right? So there are days when there are things going on, a big set of news where crypto is just going to react right away and the volumes are going to come in right away, due to the fact that you actually have some liquidity on the weekends. So I think that's why Monday's not nearly as high. But I know you've been doubling down on your views and you've been right for a long time. But
yeah,
dude, this rate market's kind of nasty.
Yeah, I must admit. So obviously, I've been like pretty balled up since mid-December or early December. Talking about this changing sort of macro dynamic as we transition from a world where Fed ran the most aggressive hiking cycle in recorded history, to coming into the pause and thinking that we'll start to position ahead of that, and then tying that in with the sort of peak inflation type narrative. Dollar started to sell off like about end of October, early November time, which I thought was a bit of a tell. So yeah, so and obviously we had our own stories within crypto, right, with FTX blowing up, and everything that came with that. But I kind of felt that a lot of the bad news was in, coming into this new year. I certainly, I think we said back in December that I felt the lows were in, which is always a dangerous thing to say.
Well, you're right.
But look, yeah. Well, let's see, right? But yeah, so that sort of thematic was playing out pretty well. I've kind of spoken before about within my to try and simplify my macro framework, where we look at sort of rates, liquidity, dollar, risk, and then sort of flows and positioning. And that's kind of how I try and look at the world. And sort of rates had peaked and were rolling over, which was like a big tick. We spoke about reasons why I think liquidity was kind of at its like tightest levels, if you like. The dollar was rolling over, so that was another big tick. Risk looked like it was settling down, and then sort of flows and positioning in the market was all pretty bearish. So you had that kind of nice stars aligned moment that kind of precedes a nice rally, which we've kind of seen. So now the question it becomes, where are we now in that sort of framework? So yeah, the rates move is worrying me quite a bit. So we've had a sort of huge sort of rates reprice over the last couple of weeks in response to better data. What's quite interesting in that is you kind of get in Twitter arguments with people about, markets are going to sell off because of recession. And there's me going, look, it's about rates and liquidity. We're a function of rates and liquidity. And here we are kind of under pressure in equities after a good rally because the data's getting better. not because it's getting worse. The worry now is that the data is going to keep the Fed engaged and keep hiking. So we've seen a super sort of sharp reprice in rates. I think we're now sort of pricing a terminal rate above 5.3%. That was sub 5 just a couple of weeks ago. So in rates world, that's pretty huge. And we had sort of 50 bips of cuts priced by the end of the year from the peak, and now that's pretty much nothing. So you could kind of argue that maybe the rates market's caught up with where the Fed has said they're going to be. One thing I will say is I kind of think there's been a bit of an overreaction to a few good data points. January data can be quite messy in terms of there's lots of seasonal adjustments that get made, and we've had quite an unseasonably warm January as well. So when you're kind of making these seasonal adjustments, because normally January's cold and no one goes out, shopping and all this stuff, so they make adjustments to try and kind of keep an underlying track of where the data would be if it wasn't for that. So hence when you throw in a warm January, that kind of messes with the data. But I don't want to be that guy that's going, I don't believe the data, because we have to take what's in front of us, right? So clearly we've had a decent run of data, be it from NFP, be it from retail sales. So that's kind of spooked everyone into thinking, right, we're not seeing that level of demand destruction that the Fed effectively want to see.
I mean, just look at the PMIs yesterday, right? Well, what did we print? The US PMIs are 50.5 versus a 47.2 expectation. That's the highest reading since June. Right?
What's weird, and what's weird, it's kind of gone, the trend of data was all going one way and everything was pointing to like contractionary PMIs, and then everywhere, not just in the US, but like we had really strong numbers out of the UK. So it kind of makes me question it a little bit. It'll be interesting to see whether that sustains. My feeling is it won't, and we'll revert back to the trend of sort of weaker data prints. But nonetheless, that is what it is. So we've had this pretty sharp repricing in rates that, all things equal, should have absolutely hammered risk and should have hammered crypto. And it hasn't. So in the sort of most recent newsletter that actually came out today, again, macro is never about one thing, and it's trying to think about it within the framework, and there's lots of moving parts. I think the other big thing that is offsetting it is liquidity. So I spoke before that liquidity is kind of getting easier. So the big sort of four central banks, if you've got the Fed, the ECB, Bank of Japan, and People's Bank of China, their net balance sheets are starting to increase because basically China and Bank of Japan are injecting a lot of liquidity and expanding their balance sheet, and it's outpacing the contraction that you're seeing at the Fed and the ECB. Also in the US, we have this debt ceiling, which means the US Treasury are having to draw down on their TGA, the Treasury General Account balance at the Fed. So effectively, without getting too technical about it, effectively, when they're building that up, they're issuing bonds, taking liquidity out of the market, and then they're keeping their cash at the Fed. Now they can't issue new debt because they've hit their debt ceiling. They're now using they're needing to go and tap that cash reserve at the Fed. So effectively, they're injecting that back into the market. So you've got that as a massive offset to QT. Plus, you've got the Bank of China and Bank of Japan expanded balance sheets. On Friday, we had the largest ever cash injection from the PBOC on their 7-day repo. So net, they injected 632 billion yuan into the market. So that's huge, right? Today, we had Bank of Japan announce an emergency bond buying operation as their 10-year yields started to push past the half BIP sort of upper limit that they have. So those two big central banks are actively engaged still basically in pumping liquidity out there. So it's a huge offset to the sort of tightening that you're seeing from the Fed and the ECB. And again, if we're a function of rates and liquidity's got a lot easier. And it's interesting for me that Bitcoin is kind of leading the rally in crypto, because if you're kind of playing that pure liquidity play, then kind of Bitcoin for me is like the ultimate kind of play on that. And I kind of think that's why Bitcoin's outperforming ETH, and why that's kind of dominating. So essentially, long story short, rates is a massive concern for me, but I think liquidity levels are still pretty high, and I think that's keeping us supported. I still think from that core thematic, and I've spoken before, like macro themes play out over a long time, and everyone wants to jump from data point to data point. I still think we're nearing a pause, and I think that's massive for a market. So I don't think 2023 is going to be 2022, and for that reason, I still think the lows are in. Like my worry would be if we see inflation sort of turn higher, and then the Fed have to actually properly re-engage if that starts to happen, and then look, all bets are off. But there's not that inflation data the other day still points to the fact that inflation's topped out and peaked out. And in fact, if you excluded shelter, which we know is lagging and is set to come a lot lower and follow sort of house prices lower.
But I don't think it's really so much a question. I think people agree that it's probably peaked. I think more so the question is it going to decrease as quickly
enough? Yeah.
As the rates are pricing, right? Like if we just gradually kind of come into this 4% inflation year over year, well, if that's the case, then that pause isn't coming. And then we're kind of back to this 2022 status quo where they need to continue to raise, and which is going to hurt risk.
Yeah, but rates of change matter as well, Joe, right? So there's a big difference between when you keep getting 75 bips come at you every month, that's a lot to adjust to. And I think, as we said before, right, crypto ate shit first, right, and got absolutely smashed. And you could argue kind of started to price that, again, that sort of change in macro dynamic into that really sharp sort of tightening cycle. And in fact, if you look at crypto, kind of peaked out in November 2021 when Powell sort of dropped the phrase sort of transitory. The thing that I still keep banging on about is Powell now at his last two outings has said the disinflationary process has begun. And I don't believe he uses those words just sort of flippantly. I think the Fed are looking at things and going, look, we've probably done enough. Yes, they still want to maintain credibility, and if the data stays strong, they can still keep going another 25, another 25. But I also think they appreciate there's lagged effect of their policy, and they're comfortable that we're starting to move lower. Now, again, does it come quickly enough? That's at the moment the answer to that is potentially no, which is why the markets are repriced. So looking at things right here, right now, I actually think crypto trades like super well given the rates move. I would have thought potentially we're lower, but I think liquidity is offsetting that. I still think we spoke before about positioning. I still think market came into this year under positioned risk generally, and we've had a huge move, so the left chasing performance. So I still kind of think that's gonna still have people sat there on the bid. And I think we've seen that pretty much. I know we've seen a little bit more sort of bearish flows, certainly in the front end, but we're still seeing people put on some top side, right? And still trying to position for top side.
Upside at this point continues to really dominate the narrative.
Yeah,
A lot of June, and then short dated, upside convexity plays, like how this Feb 26,000 strike over the past week traded 8,500 times on Paradigm.
yeah.
I mean, looking at the open interest, some of these were like closeouts of positions that were put on previously, but net, people are adding to the upside. And I think macro aside, I mean, you look at what really sparked the big rally last week, right? It was all those Mr. Sohan, you're Mr. Hong Kong, right? All those Twitter rumors, or that are starting to seem like they're being validated, that Hong Kong could potentially be the next bigger crypto hub, right?
Yeah, absolutely. Look, I mean, it's honestly, it's great news, right? It's great news. I live there, and it's really suffered over the last 3 years, not just for crypto, but for TradFi. People have left Hong Kong to go to Singapore or Dubai, just because it had a big quarantine, and it wasn't friendly. The regulation wasn't friendly, especially on crypto. So they came out with a regulation which basically said retail are likely to be able to trade crypto, only the top coins, but likely by June. And now we're going into
basically.
Yeah, they said top coins, and the rule was that you had to have them added to at least 2 indices. So yeah, it's probably going to be BTC ETH, maybe another 1 or 2. But then I think it's more like they're willing to work with people. So this is not actual rule yet; it's a consultation. So that let's chat to the major players. Let's decide by the 31st of March, what we should do, and then by the 1st of June, we'll put it in place. Wow. So I think the sign for the market. I mean, I was surprised by the size of the rally, and then I was like, well, why am I surprised, right? Because Hong Kong is a fairly small place, but it's a barometer for China, right? So I mean, Hong Kong is it's an experiment, right? Like in FX, like for example, Hong Kong had the deliverable renminbi as in Hong Kong, and that was the test, right? Like to see if the capital account can be opened up, etc. So I completely think it's a test, and they're willing to work with people and see how it goes. If it goes wrong, so be it, right? It's only Hong Kong. If it goes right, it means mainland could be in play, right? And we're talking multi-years, but I mean, it's a very drastic change to 2 years ago, where they single-handedly caused like a 50% crash in Bitcoin, right? I think it's great news, and I think my takeaway from what David is saying is like there's a lot of these external factors, like these regulatory stories that can happen, and it's great news. There's a big macro like uncertainty, like whether this inflation is peaked or not. I'm still shocked the option market is realized and implied is that low, right? Like I mean, I completely understand why it doesn't matter what direction you think it's gonna happen, like just buy some, right? Right? I mean, there's a lot of stuff that could play out in your favor, right? I mean, regulation, macro, random stories, the Shanghai upgrade, like etc.
I think that's though why you keep seeing people come in and buy it at the top side, and it's not like we think a lot of people is like directional, but there's also like probability adjusted kind of risk reward And again, like if you're a crypto fund, you know, you can't not have that exposure to the upside and the risk that it actually happens, right, and flies. So you have to own some of this stuff, because just, you know, something comes out and as we know, like, you know, crypto can move just as rapidly to the top side as it does to the downside. So yeah, there's a lot of positive stuff out there at the moment. One of the other things as well is that, you know, we had a lot of FUD around the SEC and Gensler coming out and, you know, going after staking and all that stuff. And actually, like, it wasn't that long ago, right? That would have been a good 10% sell-off. And yet crypto kind of didn't blink. And then actually the sharper rally was on the Hong Kong story. So it just shows me that sentiment's changed. There's been a pretty substantial sentiment shift towards this space. It kind of feels like it's had a lot of bad news thrown at it. It's survived. It's kind of it's weathered that storm, and now sentiment's turning quite positive. Also, as well, I think there's kind of this sense that, look, the SEC are going to do what they're going to do, and maybe crypto just builds outside of the US. And kind of the Hong Kong story kind of fed nicely into that. Like, do you know what? We can have maybe crypto builds outside of that. Now, the US would be stupid if they let that happen. But nonetheless, that's kind of feels like the route that they're going at the moment, potentially, to allow, you know, everyone else to embrace it and build around it.
Yeah, the Hong Kong announcement was quite timely, right? Like it's been very clear over the past 2 months that the SEC has been tightening its grip around crypto, and then it got really, really bad, of course, with Kraken, and then then Hong Kong comes out and, you know, smells the blood in the water, sort of saves the day. And it's pretty interesting. I mean, where are most of our upside flows like coming from? They're coming from Asia, guys.
Yeah.
There are guys that are over there, like, in this, and, like, you know, boots on the ground, kind of see what's happening. And that center of gravity that certainly shifted to the west after the Bitcoin mining got banned is now shifting back towards the east.
Joe, it was quite funny. So I was in Barcelona, and I think it was on the Wednesday night, wasn't it? And Bitcoin kind of broke higher. And I couldn't see, and I was looking to see, like, was there something out from the Fed maybe, or, you know, what was driving it? And there was nothing really obvious sort of driving it. And then a client actually messaged me saying, "Are you seeing these moves? Like, do you know what's behind it?" And and at the time, I'm in some Sky Lounge bar in Barcelona. I'm like, I don't know, but, like, I've been drinking sangria. Every sangria I have, it seems to go up. And he was like, keep going.
Actually, to be honest, it happened in the middle of the night for me, right? Like, you know, I woke up, I was like, what is causing this? And I read the headline, and I was like, oh, that headline, it can't be that headline. Surely it can't be that headline. And then I was like, wait, like, you gotta think about it, right? Like, it's not like a small isolated place, right? You got to think about it as an experiment for the future. So yeah, I guess that explains the rally.
Right.
But it's interesting, and like, bringing it back to the macro, say, given the rates move, which I think is ugly, you know, crypto trades pretty well, like, considering that the pullback after a decent move. And again, like, knock on wood here, I guess, but, like, the pullback after a decent move has been pretty shallow. So I think the price action still looks really constructive, and I'm more cautious here than I was coming into the year, just given this rates move. But I still think liquidity is high. I also question. Yeah, it feels to me, I've said before, like, Joe, I know we've spoken about this, like, the market's still trading that 2022 playbook. And I feel it's like the market's psychologically scarred by what went on in 2022. So it's interesting to me how quickly it's gone into this panic about, let's sell bonds, the Fed are going to have to hike rates in, you know, for into infinity and beyond. And they've kind of jumped on that. And I just feel it's a little bit overdone. And if rates top out here, then I think the tailwinds of liquidity, this positive sentiment, then we can take that next leg higher. So I'm still pretty positive that we're actually going to sort of take a next leg higher, but we do need rates to come down. The dollar kind of peaked out on Friday. So I think that's helping things as well. If the dollar starts to ramp up, then again, that's another part of the framework that's breaking down, that you start to get a little bit more bearish. But that seems to have kind of topped out on Friday. The other thing, and if I can share a chart,
Yeah, sure.
I always see oil's quite important as a macro sort of factor input. Let me see if I can work out how to share this chart. So you see in this chart so this is oil against 5-year break-even inflation, and like so oil for me again as a part of a macro framework is quite an important input, right? Just given the importance in the world of oil, often has sort of tight correlations with the dollar, but it also is a big sort of driver of inflation expectations, right? For obvious reasons, oil goes up, inflation goes up. And typically would lead inflation expectations. So if you look like the general sort of direction of this, as kind of oil come off, we start to see inflation expectations fall and oil bounces again, inflation expectations go up. So we've started to see oil starting to come lower again. Oil looks for me like it's going to absolutely like tank, like the price action looks awful. But you're starting to see oil come lower again, but yet inflation expectations keep going higher. And actually, if you look when inflation expectations bottomed here around the 18th of Jan, that's when US yields topped out. So inflation expectations, if you overlay 10-year yields with this, they tend to track pretty nicely as well. So the reason why I think yields are probably going to top out, and we got the Fed minutes later, and maybe that they completely embarrass me, but again, all things equal, just looking at this move in inflation expectations looks like it's completely overshot. And I think that's a market that's psychologically scarred by 2022 and the inflation narrative, the Fed hiking rates. And so you're seeing a market price in this sort of ramping inflation again, that's kind of going against what certainly what oil would suggest. And I kind of think this is going to settle down and catch back down to where oil's trading. So then as inflation expectations settle back down, because I think they've got carried away of themselves after a few good bits of data. Inflation expectations settle down, catch back down to oil. Then I think you see yields come back down. And then that's when dollar probably come back lower quite a bit. And then like that liquidity, that positive liquidity pulse that we've been talking about starts to take over, and that's when I think you'll see Bitcoin sort of blow through the resistance up through 25k and beyond, and ultimately I think we'll kind of sort of push towards 30k Bitcoin and 2000 ETH. But I think we just need to see this rate sort of pull over, and I'm looking at this chart to see will inflation expectations turn back lower. And I think if oil continues to break down, I just really struggle to see how you keep pricing in higher inflation when oil, which is such a fundamental input, is breaking down. So I'm kind of looking at this. I'm expecting inflation to roll back over, and certainly inflation expectations to fall, which will then pull yields lower. And I think that'll perhaps sort of take the sort of stranglehold off of crypto that's kind of just sort of creating that resistance at the moment. So I think that's quite an interesting chart as well to keep an eye on.
Right. Yeah. I guess the last point, because we're starting to run a little bit over here, is I totally agree with you around the Bitcoin narrative, and I think there's a reason why there hasn't been as much euphoria around Ethereum. And a lot of people, Shanghai upgrade, like, that's a great thing because it means that like Ethereum 2.0 is going as planned. But like Shanghai upgrade in terms of short-term price action is not a good thing, right? Like Ethereum has been one way. It's like literally, since I think it was the Beacon chain, right? If I wanted to stake my Ethereum, well, my Ethereum was locked up unless I did it through, Lido, which was kind of like the liquid staking protocol where I'd get the stake ETH and I'd be able to do that. But reality is 2/3 of Ethereum that is currently staked is illiquid, right? And if you look at, there's some pretty good research around this, that at current prices of Ethereum 1700, around 60% to 2/3 of people that have staked their ETH are underwater, right? Because they were staking at 2,500, 3,000, right? And then of course, there's people that, had staked a lot earlier and definitely making money. But you could make this argument that there's this pent up withdrawal demand. right? That as soon as I'm able to get my money out, and of course the Ethereum withdrawals are subject to I think something like 50,000 like Ethereum per day. It's not like it's a rush for the exit sort of thing. It's going to happen over time. Well, if there's this pent up withdrawal demand, and then for the foreseeable future, you just have all these net outflows of ETH, of people just trying to get the heck out of this thing. Well, what's going to catch that? Well, it would need to be institutions coming in and being ready. But if there's that supply demand imbalance of, okay, if Shanghai upgrade happens, and then you have all this ETH supply that's coming from this, and you're not having institutions coming in and catching it, well, Ethereum's short term, I mean, I think we'd agree that long term, the Shanghai upgrade is very good, right? Because in the current state of Ethereum staking, the percentage of current market value staked for Ethereum is very low compared to other blockchains, because it's it's one-way staking at this point. So I think we agree long term it's great, but in terms of short term, this can be pretty nasty.
Yeah, I mean, I think we could do an entire podcast on the Shanghai upgrade, to be honest, and I think that's a great idea for next week if you have if you have nothing to talk about. But
Joe, what's interesting to me,
there's nothing. I know there's no set date in terms of where this is going to happen, when this is going to happen, but I mean, I think everywhere I'm reading is telegraphing late March that this is going to happen.
That's the
term structure.
Yeah,
there's nothing really being priced there.
But Joe, my actual thinking's the other way on the Shanghai upgrade. So, like, ETH's my biggest position, right? Sorry for any Bitcoin maxis watching this, but ETH's my biggest position. I've got a chunk of that staked because I've got a long-term view on this. And when I staked that ETH, I knew it was locked up indefinitely, right, or for a long time. And this is right before we've even had the merge and what have you. You start locking it up, and then you got to wait for the Shanghai upgrade. So the sort of mindset that would have locked that up is probably a long-term holder, I would say. And for me, the chances.
I think it depends on the price that you lock it up at. I would agree the people that are locking it up at $500 of ETH, yes, are probably the long-term holders. But the people that are locking it up at 3,000 and who are deep underwater are going to have a higher propensity to sell than somebody that is, in the money on it.
See, like, the reason I think differently on that is because if ETH was, say, at 10,000 now, right, my propensity to sell would be a lot higher, because I'd be, shit, that's going to be a lot of money for me, right? So, basically, I don't know if you've kind of had it staked and you were staking it at 3,000, whatever level that you were in at, like you're massively underwater, right? Are you going to bring that money out and go, well, let's just crystallize the loss? Or are you going to go, do you know what? It's been there. Let's just leave it now and see what happens. Like, I kind of think there's that element, and then offsetting that as well is the other flows of those that wanted to stake but didn't want to lose the liquidity from staking, i.e. I want to have access to it if I need it, will now go, do you know what, I can tie that up.
That's a really good point, actually. That's a really good point, because it actually opens up a whole different world of people who have liquid staking now available, right?
Right.
Yeah. So I mean, maybe that balance kind of isn't as bad as we think. But also, like, I mean, I'm the same way, right? Like, as in, if I have an in the money instrument, I probably am less likely to sell. If I'm something which is down 50%, I'm very likely to sell. And in general, people in crypto have suffered in 2022, right? I mean, most people have lost a significant portion of their bags, right? So, I mean, I would think even the long-term hodlers, they will have like more of a sell pressure. It's just whether, there's new people who are coming in, and the chain is like now more safe. So, I think that's what's gonna define how it goes.
But I agree. Yeah, more safe. But like, I mean, Mr. Rates over here. I mean, what are Ethereum staking yields? What, 6%? I mean, compare that to what you can get in a 10-year treasury, right? If I'm just looking at where I am on my risk spectrum, I mean, don't get me wrong. Like, I believe in the whole thing. I'm just trying to be the devil, play devil's advocate here, as he may be an institutional guy that involved. Like, oh, I get 4% treasury yield versus 6% staking it. with this validator node where I don't know what the hell they're going to do.
Yeah, fair. That's fair. The other thing I think with ETH that might be holding it back a little bit relative to Bitcoin is, again, Gensler going after calling anything that moves a security. From what I understand, Bitcoin is the only thing that he's kind of classified as a commodity. So it's kind of like, I can understand people going, look, if I'm bullish crypto, I don't know what the SEC are going to do, and I'm unsure around that. Then maybe Bitcoin is just a cleaner play at this moment. So I do think that's hampering, and probably my biggest fear as an investor into Ethereum is, if he comes out and labels it as a security tomorrow, what does that mean? So you kind of sit there and look at that and go, well, is it just easier to be holding Bitcoin? So I wonder how much that is playing into investor psychology as well.
That's true. I think that's a really good point to end on.